Chapter 9, Part 2. Let's take a look at inventory costs. Inventory carrying costs are those that are incurred by inventory at rest and waiting to be used. From a finished goods inventory perspective, inventory carrying costs represent those costs associated with manufacturing and moving inventory from a plant to a distribution center to await an order. There are four major components of inventory carrying cost: capital cost, storage space cost, inventory service cost, and inventory risk cost. Another cost affecting total inventory cost is ordering cost or setup cost. Ordering cost refers to the expense of placing an order and does not include the cost of the product itself. Setup cost refers more specifically to the expense of changing or modifying a production or assembly process to facilitate line changeovers. Another inventory carrying cost that many organizations ignore is that of carrying inventory in transit. Someone will own the inventory while it is in transit and will incur the resulting carrying cost. In-transit inventory carrying cost becomes especially important on global moves since both distance and time from the shipping location increase. Stockout cost is the cost associated with not having a product available to meet demand, and several consequences might occur. First, the customer might be willing to wait and accept a later shipment, like back order. Second, the customer might decide to purchase a competitor's product, in this instance resulting in a direct loss of profit and revenue for the supplier. Or third, the customer might decide to permanently switch to a competitor's product. Stockout costs can be difficult to determine because of the uncertainty of future consequences that might occur. Order carrying costs and carrying costs respond in opposite ways to changes in the number of orders or the size of individual orders. Total cost also responds to changes in order size. Let's take a look at some approach to managing inventory. Specifically, we'll look first at the fixed order quantity approach. Until now, the reorder point was based on the amount of inventory on hand and demand was known and constant. When inventory on hand reaches zero, a new order was received in an economic order quantity and stockout costs were not incurred. Most firms would not operate under conditions of certainty for a variety of reasons, and several factors can affect lead time. Because of all the potential factors that can influence the reliability of demand and lead time, inventory models need to be adjusted to account for this uncertainty. The second form of the fixed order interval approach to inventory management is also called the fixed period or fixed review period approach, which involves ordering inventory at fixed or regular intervals. In comparison with the basic EOQ approach, the fixed interval model does not require close surveillance of inventory levels. Thus, the monitoring is less expensive, which is best used for inventory items that have a relatively stable demand. Using this approach for volatile demand items might quickly result in a stockout, since time triggers orders rather than inventory levels. Like the fixed order quantity approach to inventory management, the fixed order interval approach typically combines elements of both the pull and push philosophies. Managing inventory involves two fundamental questions: how much to order and when to order. But now questions regarding where inventory should be held and what specific line items should be available at specific locations pose challenges to managers. The current dynamic operating environment has caused organizations to examine their inventory policies as well as their customer service policies and find the optimal solution that balances both service and cost. Many approaches exist to identify and analyze this trade-off. Organizations will choose the approach that serves them the best as defined by their markets and corporate goals. Several factors make this approach achievable. Number one, real-time order management systems. Number two, improved technologies to manage logistics information. Number three, more flexible and reliable transportation resources. And number four, improvements in the ability to position inventories so that they will be available when and where they are needed. Let's look at dependent versus independent demand, which is one of the key factors in terms of inventory management approaches. Demand for a given inventory item is termed independent when such demand is unrelated to demand for another item. Conversely, Demand is defined as dependent when it's directly related to or derives from the demand for another inventory item or product. An important point to remember is that developing inventory policies for items exhibiting independent demand requires that forecasts be developed for these items. The approaches to inventory management to be discussed include just-in-time, JIT, materials requirements planning, MRP, and manufacturing resource planning, MRP2. These are usually associated with items having dependent demand. Alternatively, DRP generally involves the movement of items having independent demand. The economic order quantity, or EOQ, and vendor-managed inventory approaches apply to both independent and dependent demand items. Push versus pull. The pull approach relies on customer orders to move products through a logistics system, while the push approach uses inventory replenishment techniques in anticipation of demand to move products. A principal attribute of pull systems is that they can respond quickly to sudden or abrupt changes in demand because they produce to an order and have very little, if any, finished goods inventory. Pull systems usually run on short-term forecasts, allowing them the flexibility to adapt to swings in demand. JIT is a pull system since organizations place orders for more inventory only when the amount on hand reaches a certain minimum level, thus pulling inventory through the logistics system as needed. Having established a master production schedule, MRP develops a time-phased approach to inventory scheduling receipt. MRP and MRP2 approaches are push-based because they generate a list of required materials in order to assemble or manufacture a specific amount of finished products. DRP involves the allocation of available inventory to meet market demands. DRP on the outbound or physical distribution side of logistics is also a push-based strategy. VMI uses preset reorder points and economic order quantities, along with on-hand inventory levels in customers' warehouses, to generate replenishment orders and can be considered a push approach. Finally, the EOQ approach is generally a pull approach. Systems-wide versus single facility solutions. A final inventory management issue is whether the selected approach represents a system-wide solution or whether it is specific to a single facility, such as a distribution center. Basically, a system-wide approach plans and executes inventory decisions across multiple nodes in the logistics system. MRP and DRP are typically system-wide approaches to managing inventory. Both approaches plan inventory releases and receipts between multiple shipping and receiving points in the network. On the other hand, a single facility approach plans and executes shipments and receipts between a single shipping point and receiving point. EOQ and JRT are normally considered single facility solutions. Both release orders from a single facility to a specific supplier for inventory replenishment. Usually MRP and DRP are employed to plan system inventory movement, and EOQ and JIT are used to execute these plans at a single facility level. VMI can be used to plan system-wide replenishment as well as execute replenishment on a single facility basis. Let's look at some key differences among approaches to managing inventory. So you see the summary here, which I think helps encapsulate some of the differences quite well. The fixed order quantity model involves ordering a fixed amount of product each time reordering takes place and uses a minimum stock level to determine when to reorder the fixed quantity. This is called the reorder point. When the number of units of an item in inventory reaches the reorder point, the fixed order quantity, the EOQ, is ordered. The fixed order quantity model is often referred to as the two-bin model. When the first bin is empty, the organization places an order. Both notions, trigger and bin, imply that an organization will reorder inventory when the amount on hand reaches the reorder point. The EOQ model, of course, makes a few assumptions, such as a continuous constant known rate of demand, a constant and known replenishment or lead time, that all demand is satisfied, a constant price or cost that is independent of the order quantity, no inventory transit, and no inventory no interaction between items. Let's look at the fixed order quantity approach. Many organizations have become more sophisticated in their use of EOQ-based approaches, adapting them to include a push as well as a pull orientation. As a result, many EOQ-based systems effectively blend both push and pull concepts. One principal shortcoming of the EOQ-based approach is that it suits inventory decision-making at a single facility more than it suits decision-making at multiple locations, and can sometimes encounter problems when parallel points in the same logistics systems experience peak demand simultaneously. Let's look at fixed order quantity approach. Until now, the reorder point was based on the amount of inventory on hand, and demand was known and constant. When inventory on hand reached zero, a new order was received in an economic order quantity and stockouts were not incurred. Most firms would not operate under conditions of certainty for a variety of reasons, and several factors can affect lead time. Because of all the potential factors that can influence the reliability of demand and lead time, inventory models need to be adjusted to account for this uncertainty. Let's look at the JIT, or just-in-time approach. Generally, JIT systems are designed to manage lead times and to eliminate waste. Ideally, product should arrive exactly when an organization needs it, with no tolerance for late or early deliveries. Many JIT systems place a high priority on short, consistent lead times. However, in a true JIT system, the length of the lead time is not as important as the reliability of the lead time. The just-in-time concept can enable logistics managers to reduce unit costs and to enhance customer service. A close examination of JIT-based approaches show that they resemble the more reactive systems, such as the EOQ and fixed-order quantity approaches, since JIT is demand responsive. A principal difference between JIT and the more traditional approaches is the JIT commitment to short, consistent lead times and to minimizing or eliminating inventories. In effect, JIT saves money on downstream inventories by placing greater reliance on improved responsiveness and flexibility. Ideally, the use of JIT helps to synchronize the logistics system so thoroughly that its operation does not depend on inventory strategically located at points throughout the logistics system. All right, let's look at materials requirements planning. Another inventory and scheduling approach that has gained wide acceptance is material requirements planning. MRP deals specifically with supplying materials and component parts whose demand depends on the demand for a specific end product. Only recently have technology and information systems permitted organizations to benefit fully from MRP and to implement such an approach. Another inventory and scheduling approach that has gained wide acceptance, as we said, is MRP. And here you can see something of a diagram of an MRP system. Like anything else, MRP has its advantages and disadvantages. Among the advantages are the fact that the attempt to maintain reasonable safety stock levels and to minimize or eliminate inventories whenever possible. They can identify process problems and potential supply chain disruptions long before they occur and take the necessary corrective actions. And I'll let you read the rest of the advantages. Of course, there are disadvantages as well, and I'll let you take a look at those. And then I want to look at distribution requirements planning, which is a widely used and potentially powerful technique for outbound logistics systems to help determine the appropriate level of inventory to be held to meet both cost and service objectives. DRP determines the replenishment schedules between an organization's manufacturing facilities and its distribution centers. It is usually coupled with MRP systems in an attempt to manage the flow and timing of both inbound materials and outbound finished goods. The underlying rationale for DRP is to more accurately forecast demand and to explode that information back for use in developing production schedules. Vendor-managed inventory. A relatively new inventory management technique, vendor-managed inventory, manages inventories outside an organization's logistics network or is a technique to manage its inventories held in